Hello, everybody. Welcome to another one of the Nebraska Farm Bureau's Inside Profitability webinar, part of our series of webinars, podcasts, and social media events that are focused on farm and ranch profitability. I am Jay Rempe. I'm Senior Economist for Nebraska Farm Bureau, and I'm the host for today's event. Just as a bit of a background, the Inside Profitability series was started about a year ago. We try to focus on topics that are essential to producer profitability. And what I think try to make our webinar unique, these are topics that are identified by our members as ones that they feel that some of the issues that they're working through on their farm and ranch, and ones that they think are worthy of a webinar to provide some information, I guess, if you will, on managing and maintaining an economically viable farm and ranch. And we certainly hope you find this webinar informative and provide you with information. And if you have an issue or something that you're working through on your farm and ranch that you think, hey, maybe others are struggling with this too, I could use some information on this, please let me know, because we'll take a look at it and try to focus on that and look into it. And if you have one of those issues, shoot me an email at jayr@nefb.org, and we'll certainly look into it. Today, we're going to focus on drought. Much of Nebraska right now is under some form of a drought. As of late May, the last drought monitor, 98% of the state was in some form of drought, and nearly half the state was in either a severe, extreme, or exceptional drought. So the recent rains have helped, but drought is still on a lot of producers' minds. And it looks like this year, the National Weather Service last week projected that Nebraska is going to continue to see a hot and dry summer and continued drought. So this is one of the things that producers are going to be working through this year. And obviously grain markets will be one that crop producers will be making a lot of marketing decisions based around their crop. And so today, to have us work through some of these things that maybe producers should think about during a year of drought, we have Kevin Gonnerman. Kevin is a risk management consultant with StoneX office in Omaha. Kevin is a native of Nebraska, grew up on a York County farm, and he did farm for a while in York County for 15 years, an operation in York and Polk and Butler County, around 1,500 acres, if I remember what he told me. Following farming, he transitioned into risk management and first worked for a retail commodity brokerage firm in Kansas. Then he moved to United Farmers Co-op, now Central Valley Ag in Nebraska. And then he moved into his current position in 2012 with StoneX. And at StoneX, Kevin works directly with grain producers in marketing and risk management, as well as developing grain hedging strategies for commercial clients, and provides them with grain origination and cash marketing programs for producers. So I think we found the right guy today to talk to us a little about marketing and things producers should think about. So Kevin, thank you very much for joining us. Appreciate you having us or joining us today. We'll let you take over and go from here.
Well, thank you very much, Jay, for the opportunity to be here with your producers and with the farmers across the state of Nebraska. As you mentioned, I did farm 15 years, and production ag in Nebraska's got a soft spot in my heart. So we're going to have our Farm Bureau marketing decisions outlook here this morning. It's going to run about 15 to 20 minutes, so it's not going to take all day. No need to worry about that. The compliance department and the lawyers are going to require that anytime we talk about futures, options, over-the-counter type of products, that we must read our disclaimer. So just a few of the highlights here is this type of trading is not suitable for all investors. Derivative trading does include substantial risk of loss, and you should fully understand those risks prior to trading. Secondly, this material, we are going to talk about one grain contract during our presentation, so it needs to be construed as a solicitation of trading strategies. Although we're not talking about a specific company, we are talking about a specific market. The company is not responsible for any of the information that I'm presenting here today. All forecasting statements made with this material represent my opinion and not the company's. And I've tried to gather that information from reliable sources, although the lawyers won't let me guarantee its accuracy. So we got that done. Today we're going to talk about inflation, interest rates, summer US weather, corn, soybean markets, and finish up with the grain contracts, all in about 15 minutes. So hang on, here we go. This is the consumer price index for all urban consumers. It was shortly after the first of the year. And let me see if I can move this so that you can see it in its entirety. You can see at this point in time, the inflation rate had just breached 5%, the highest it had been since 2008. And really now that we're at 8-9%, we're as high as what we have been since probably the early 1980s. And with each occurrence in which the consumer price index inflation rate was above 5%, the US economy has fallen into a recession. Talk here about interest rates. The Federal Reserve Board will lead from behind, quote unquote, if you will, not wanting to throttle down an economy or put people out of a job. So they're usually always chasing inflation from the backside. When I started my fall series of meetings with producers, I had this picture of Albert Einstein, and I said, if you're under the age of 70, you need to find someone who's 70 years or older and have them walk you through what the 1970s were like, and then what occurred on October 1979 when Chairman Paul Volcker had a press conference. It was unexpected, unannounced, and it's been called the Saturday Night Special, when he raised interest rates. And you need to understand what the economy was like, what the inflation environment and interest rate environment was like back in the 1970s. It's very similar to what we see in the United States today. As we shift our focus to weather, looking at long-term warming trends globally, I thought this was really very interesting. It's from one of our weather consulting firms that we use here at StoneX. The company is Maxar. And we can see here that prior to 1940, the world was much cooler than what it currently is. And there was a transitional phase from the 40s through the 70s, a 30-year period where there really wasn't a trend. But beginning in 1980, you can see that the chart shows a steady and significant increase in the warmth of global temperatures. And that continues today. And what that has done, it's actually lengthened the growing season here in the United States by about 2 weeks. As Jay has already alluded to, looking out to summer forecasts, and I don't have the temperature forecast maps on this screen, just the summer rainfall maps. The forecast still looks like the plains, north to south, are going to be below normal in precipitation, and that includes the state of Iowa. The rest of the Corn Belt should be average to slightly above average in moisture. So as we now shift into the commodity markets, and we'll start with corn. I have corn and soybean histories with me today. We'll talk about the seasonality of December corn. You see that there is generally a period of time from May 1st to July 15th in which historically corn will make its summer highs. And that will also be the seasonal high. And we have entered into that window. This being recorded on the last day of May, we're 30 days into that window. And we are beginning to see prices respond to the flooding that's in the northern plains, some of the wetter conditions that we've seen early in the spring in the eastern corn belt. And the market has made new highs here during the month of May. But just how many days in the last 10 years have we really been above $6 for December corn futures? And this slide here will show you that less than 5% of the time does December corn trade above $6 in a range from $6 to $8.40. And only 17% of the time in the last 10 years have we been above $5.20. So basically 20% of the time in the last 10 years, we've been above $5.20. Looking at November soybeans, your window is just a little bit longer than what it is for December corn. Now, the high range period here runs from May 1st through July 20th. And then there are some years in which we have a post-harvest rally that the highs are made after harvest into the end of October. And when we look back in the past 10 years for November soybeans, only 3% of the time have we been above $15. And if we go back to $13, only 13% of the time have we been above $13. What these histograms are indicating to us is the frequency in which we are at these high levels. And when we're at these high levels, they don't last very long. One of the contracts that we want to utilize this year, due to the high prices that we currently have, and also due to the uncertainty that we're going to have with yield, is a type of contract that gives you a floor while maintaining upside price possibilities. The contract that I've listed here today is called a Producer Weekly Flex Floor Advantage contract. It's going to price for 14 weeks. The futures price, minimum price, is going to be $7.24. That will cost you 38 cents to have the opportunity to have a floor at 7.24, and we deduct that option premium. That cost, the 38 cents, gives you a net December futures price of $6.86. Now, you will have to subtract your local basis in order to get your cash contract price. When we compare that with a short dated new crop September at the money 7.25 corn put that will expire August 26th, that option premium is going to cost you 51 cents. So for the same time window here, using the Producer Weekly Flex Floor Advantage contract, your cost is actually going to be 13 cents less. Your net December futures price is going to be $6.74 versus $6.86, and you still have to subtract your basis, your local basis, to get your cash price. Now, if a person wanted to balance this against the standard December 7.20 at the money corn put that expires the week of Thanksgiving, the option premium for this contract is 60 cents, resulting in a net December futures price of $6.60. You will still have to minus the basis, your local basis, to get your cash price. This is just one opportunity that shows you the different types of contracts. We've got 3 different contracts here that achieve the same end result, which is to give you a floor for your futures price and still grant you the opportunity to set your basis at a later time. And it will price the bushels. These bushels will be priced irregardless if the market's at $8 or if the market's at $6. There's no characteristic in which the pricing window would end. Also, you need to know what your cost of production is and what your profitability above your variable costs are. This chart here is produced by one of our customers, the CFO, Fran Swan of Central Valley Ag Cooperative in York. And it shows us that back on January 31st, irrigated corn profitability above variable costs was in the ballpark of $2.36. Or excuse me, let's repeat that. It shows us that the profitability above variable costs for irrigated corn was $236 per acre. Ironically, irrigated soybean profitability above variable costs were also $236 per acre. Since the end of January, we have seen a significant rally in both commodities. However, the profitability has increased dramatically with irrigated corn. When we got through February and our pricing period for our federal crop insurance on March 4th, our irrigated corn profitability had risen to $309 per acre, while the soybean profitability increased to $270. At the end of April, irrigated corn profitability had hit $580 per acre. The irrigated profitability for soybeans was $291 per acre. And our last estimates have that at about $547 and $298. So you can see the market has made a dramatic attempt to increase the amount of acres the US farmer will plant to corn. Another type of contract to use during this period of seasonal strength with the uncertainty of what direction prices are going to go is an average seasonal price contract. You won't hit the high, but you won't hit the low. It's an average over a set number of weeks. One other contract to consider after the growing season is over and you have made your forward contracted sales, if the situation would require the opportunity that you would want to have some price exposure in case the futures market would rally, the extended price contract would be the contract of choice. The takeaway points here today, Jay, in this presentation are the times are changing. Inflation is not zero anymore. Interest rates aren't near zero anymore. And so much of the last 40 years, we've been in an environment where interest rates continued to get lower and lower and lower. That has passed. We have put in the lows, and now you need to fix your interest rates if you have any adjustable rate mortgages, any adjustable rate financing packages with your lender. Point number 2, prepare for uncertainty and volatility. We've had this presentation primarily put together prior to the end of February, and that is when the ground war in Ukraine began. And really, when you think back upon it, this is really the first ground war we've had in an agricultural production area since World War II. How is the market going to respond to that? Point number 3, we want to use contracts with guaranteed floors and prices. We don't want the type of contracts that limit the amount of bushels that are sold in the event that the market should show signs of weakness, nor do we want a type of contract in which we could have additional bushels priced should we have a severe drought this summer and prices rally. And finally, I always end all of my presentations with don't speculate with your business. Know what your cost of production is, know what your profitable levels are. Don't trade a commodity market, but manage the risk in your business. I want to thank you for your time here with us today. I hope that you've learned something from this presentation. And if you have any questions, you can reach out to Jay at a later time. Jay, back to you.
Thanks, Kevin. Lots of good information there, and I'm just fascinated with these kinds of presentations in the grain markets and what's happening. So thank you very much. I appreciate that. Just a couple quick questions, just to clarify a couple things, just to make sure I'm following you and for our audience. On the basis when you say when you're looking at those different types of contracts you can use to manage your risk but the basis you're looking at is the basis at the time of harvest when you typically would sell your grain or take your grain into the elevator. Is that correct? The average basis at that point in time?
Yes, it would be. On a forward cash contract on new crop production, you would most likely be looking at harvest delivery. And so the basis value would be your new crop harvest basis value.
Okay.
The difference between your local cash price and the futures price set in Chicago.
Okay. And then some of the profitability figures that you shared, Kevin, what was the price that was used to look at that profitability? Was it the December futures contract on corn and November on soybeans, or what were you using there?
Yeah, that's what the calculation was based on.
Okay.
I would have to go back to each weekly distribution of that graph to find out what the values were that day. And I could supply you with that if you'd like that.
Oh, I think that's fine, Kevin. I just wanted to make sure that's what we're looking. So the short story is that it appears there's still some profits that can be made this year, even with the higher input costs that we're seeing, given what's happening in the grain markets right now.
That is correct. Yes, the input costs, those variable costs, were current variable costs. They weren't costs from input fertilizer costs from last fall. They were as of that week.
As of, okay, great. And so one of the questions that come to mind, if I'm a dry land producer in Nebraska, and I'm a little worried about the drought and the lack of moisture, lack of precipitation, and what that might mean for yields, do I change my marketing this year in terms of how much I market or how much I try to lock in because of the question mark around the yields this year?
I think the rules or the discipline in forward contracting remain about the same, Jay.
Mhm.
What does change perhaps though is the type of contract that you use. If I was a dry land producer and concerned about what type of production levels I was going to have, rather than making a delivery commitment with a forward cash contract, I would be using some sort of put option contract to give me a floor at these very high levels, but yet leaving delivery flexible, so that in the event that my production level isn't as high as what I'd hoped it would be, that I haven't made a commitment to a local grain company that I owe them bushels.
Okay. And just a bit of a follow-up there. If I've never used a contract like this before or have forwarded contracted and typically wait and try to sell my grain at harvest time or store it into the next year, but I was interested this year in looking at doing something like this, what steps should I take or how best to do that?
I think the first thing, and it seems pretty simplistic, but in reality it's somewhat difficult, is accurately know your cost of production. And in a weather environment in which you are suffering some drought reductions, be honest in what that yield estimate is going to be, so that you do have a fairly realistic idea of what type of cash price I need to have in order to make a profit this year. Point number two, you want to sit down with the grain merchandising or grain origination staff at that grain company in which you plan to forward contract your crop, so that they can explain to you what your responsibilities are, what their responsibilities to you are, and how each of these grain contracts function, so that you can ask them face to face, what will the company do in the event that I have an act of God, a drought or a hailstorm 2 weeks prior to harvest, and my crop size is dramatically reduced? Are there penalties? Am I allowed to buy out of a contract? Do I have to roll that contract from one production season into the next one? Each company is going to have just a little bit different terminology and a little bit different avenues of how they finalize that type of shortage. So you want to understand, totally understand how that contract works and what your responsibilities are. And then finally, Jay, you want to start small. If in an environment where one, you haven't been doing a lot of forward contracting to begin with, forward contracting something that you haven't produced yet can be somewhat emotional. It can be nerve-wracking. It can cause you to be anxious. Couple that then with a drought situation where every day you leave house and you drive out to the fields and corn plants are turning purple or wheat plants aren't growing, that in itself causes additional stress. So you want to forward contract smaller increments and perhaps just a little bit less frequently than you would in an environment where you just got a great rain, come out of dormancy looking fantastic this spring, and it's going to be a bumper crop.
Thanks, Kevin. I appreciate that. I was curious, your slides on the seasonality and that you showed. I just saw I think it was Purdue University had looked back 30 years, and it showed the seasonality. It showed the same thing looking back 30 years, that the ties typically occur sometime in May, June, or early July, both for corn and soybeans. I guess my question is, if I'm a producer, I'm sitting here and we're looking like we've got some drought this year. Does that seasonality typically hold during drought years as well, too?
Yes, it does.
Does it?
Surprisingly, Jay. What will happen is the futures market is always looking ahead. And so when the futures market is able to have some idea of the size of that crop, it does at that point in time to begin to reduce that risk premium that it built into futures prices. Now, that doesn't mean that after harvest, you still won't have marketing opportunities. As we've seen recently, the basis levels accelerate and are much higher than historical standards. We see a futures market where it doesn't want to pay you to store a crop. It doesn't pay a carrying charge in its price structure. It's inverted. And so it's requesting those bushels move earlier. So there is still opportunities post-harvest if a person was uncomfortable making sales earlier in order to reward a market in which it was a short crop. Has a person done some forward contracting and then the national corn crop or the national crop is smaller than expected? So that is then where one of those additional type of contracts, the extended price contract or a minimum price contract, would give you the opportunity to re-own and have some price exposure to the futures market if the national crop was smaller that year.
Okay. And just to follow up a little bit on our earlier discussion of profitability and the seasonality. So if it seems like right now, given the seasonality and the current state of things, that a producer would have an opportunity to lock in some profits right now, but then at least on a portion of their crop, and then they could see if the opportunity presents itself in the future. Is that a good way of saying, or
yes, that's a great way to say it, Jay.
Okay.
The futures market rally that we've experienced this spring has given us perhaps record level type of profitability from the marketplace without government payments, strictly from the marketplace, that these levels give the producer an excellent opportunity to be able to lock in some profits, or like the wheat market. I mean, specifically, our wheat crop is one which has struggled with the lack of moisture, that it's really difficult to go out and sell 25 bushels per acre, 30 bushels per acre of your historical yield, where I realize put option premiums are expensive this time of the year, given the crop that we have, but we aren't talking $6 wheat or $7 wheat. We were talking $11, $12, $13 wheat futures. Those type of values, you're going to have to spend some money to protect them, but it gives you a floor. It grants you the opportunity to see what your harvested bushels are going to be like without opening the door to all the downside and the risk of losing that profitable price environment, which you had a chance at. Right.
I like the way you said that, Kevin. Spend some money to protect some of that value. I think that's a great way to phrase it. One final question here, and then we need to wrap it up for time. But in one of your last slides, you mentioned the volatility and the uncertainty. And you've been in the business for many years from both the farmer standpoint and from a risk management standpoint in pricing grain. It seems to me as an outsider that the volatility over the last 3 years has really ramped up. Is that true? Is that an accurate perception, or am I off base there? And we're still have about the same volatility. It's just the levels of prices have changed.
Well, Jay, let me ask you, do you think that the wind's been blowing more this spring than what historically it has?
Yes, I do.
Yes, I think you're right. No, actually, we do track that. We're a little bit like baseball. We track everything. And so volatility is one of those things that we do have charts for. And this winter, the volatility that we've seen in price swings in corn, soybeans, wheat has actually been higher in the wintertime during periods of quiet steadiness than it is during historical summer production volatile times. That's how volatile it has been. And that's why the market It's hard to kind of explain, but the market gets tired. The market's made up of people. And this emotional yo-yo of up and down and huge price swings and the volatility that comes along with it has led to a reduction in the size of volume that we see in trading. That has given to greater volatility as there are price vacuums within a day of no buyers or no sellers, and the market just runs. And there's no fundamental explanation on what is occurring within the price structure today.
Well, thanks, Kevin. I think we could carry this conversation on for a long time, but unfortunately, we need to wrap it up. So I really appreciate you taking the time today and talking with us and sharing some of your information. Once again, if somebody wants to get a hold of you directly to carry on this conversation or ask some further questions, with your contact information again, would you share that with us?
Sure thing. My direct phone line here in Omaha is 402-861-2501. And you can follow me on Twitter as well.
Okay. Thank you very much, Kevin. And thanks everybody for joining us today. Again, this is one of our series of webinars focused on farm management issues during the drought. Today, we focused on grain marketing. Others will focus on water management if you're an irrigated producer, and then some crop insurance issues as well too. So to find more information on these webinars and to watch them, please go to www.nefb.org, and you'll find all the information presented and other webinars there. So thanks again, Kevin. Appreciate you joining us, and we'll close this down.